Hi, this is Dave Myers with Paper Trail Financial with screencast number 2 regarding analyzing and managing your accounts payable using information from your QuickBooks statements. When you're looking at your cash conversion efficiency, payables have the opposite effect on cash flow than accounts receivable or inventory. The faster inventory is turned into a sale and the faster you collect on that sale, the greater the availability of cash. Conversely, with accounts payable, the longer the amount of time from when an expense is posted until it actually gets paid, the longer cash is on hand. So it's beneficial to not only actively manage your sales and receivable workflow, but to also actively manage your accounts payable liability as well. This is the worksheet that we created in the last screencast, where we calculated AP turnover, which is the average amount of times payables turn over within the period, in this case a year, and the AP days ratio, which is the days payable outstanding, which tells us the average amount of time payables remain unpaid. To take the analysis a little bit further, I want to look at trends monthly in accounts payable. So to do that, I'm going to create 2 new columns. We'll call the first one here $AP change, and the second one will be the percentage change in accounts payable. And I'll match the formatting. To calculate the change is easy. I'm just going to subtract January from February. So February minus January. And then I can have Excel fill in the rest. And I'm going to change the number format so we have the negative numbers stand out in red. To get the percentage change, we will take the dollar change and divide it by the total for the previous month. I'll make it bold and fill it in. The negative numbers in red represent a reduction in payables, which adversely affects cash flow in those months. The 4 months that stand out to me start in March, where first we see a $23,000 decrease in payables. Followed in the next month, the increase is only $1,500. The next month, the decrease again is large, $19,000, followed by only a $3,000 increase in payables. Together, this could have a significant influence on the cash position of the company. September and October are somewhat of a wash, and then payables expand a little bit at the end of the year. These fluctuations aren't a bad thing. In fact, they're probably a positive because they show as if ownership is actively managing payables and managing the outflow of cash from the business. In order to get a more well-rounded look at the payable trends beyond just the changes in monthly balances, I'll calculate the payable ratios by month. So I'll create 2 new columns. One is going to be the AP turnover, and the other is the AP days. And I'll match the formatting. So the AP turnover ratio is going to be cost of goods sold divided by accounts payable, and I'll change the number format so we don't have so many decimal places, and I can just fill this in. The AP days is going to be, in this case, because it's by month, it'll be 30 days divided by the AP turnover ratio. And I'll have to fix the decimal places here too. And we'll do the same thing, number, we'll keep it at 2 decimal places, and I can fill this in. In order to make the AP days trend stand out, I'm going to use some conditional formatting. So if I highlight it and use conditional formatting, and I'll choose greater than, and in this case I'll use 30 days because that's our greatest terms from vendors. We'll fill it in green. Here we can see both the monthly and collective effects from changes in payables. The dollar change column highlights in red the negative effects on cash flow due to changes in payables month to month. The AP days column shows the overall effect of payables on cash flow because the ratio involves the total balance of the payables account. The payables balance in the first few months provides a cash flow cushion due to the business's ability to stretch their payables in those months. I want to do one more comparison here. I want to compare the payable balance to total revenues. So I'll create a new column and call it revenues, and let me format it to match. To get the revenues, I'll switch back to the profit and loss and highlight the total income line and minus the actual total column. I'm going to paste special and choose values and transpose, and I need to fix the number format, and I'll embolden the font. And rather than add two more columns for comparison's sake, I'm going to go ahead and take the AP info and the total revenue info and put it in a graph. What we see here is the revenues as opposed to cost of goods sold compared to the monthly accounts payable balances. It reinforces what we saw in the ratio analysis, and that's that the business is stretching its payables out in months when sales are slower. Now, there are 2 points that I'd like to mention regarding managing payables. First, tweaking payable timing is a short-term remedy for cash flow issues. The improvement in cash flow isn't sustainable. In other words, the bills are still going to have to be paid at some point. This leads me to my second point, that favorable terms from a vendor can be just as important as pricing. The ability to stretch out payable turnover time with little or no financial penalty can provide your business with the ability to not have to tap into a revolving line of credit for working capital or dip into cash reserves.